Good evening, and welcome back to Stock Daily. It is Tuesday, September 16th, 2025, here on the U.S. East Coast, and we're recording tonight at 10:30 p.m. The markets opened higher today but quickly lost momentum, drifting into narrow intraday ranges. This muted trading session was less about fundamentals and more about anticipation. Investors are sitting on their hands ahead of tomorrow's Federal Reserve policy meeting, an event that could shape the trajectory of markets well into 2026. The expectation is straightforward. The Fed is widely seen cutting rates by 25 basis points. But the real story is not the cut itself, it's what comes next. Tomorrow, we'll get the updated summary of economic projections, the famous dot plot, and Fed Chair Powell's press conference. Those will tell us far more about the path of policy. Is this the start of a long easing cycle, or just a tentative first step? Is the Fed willing to accelerate if growth falters, or will it stick to a cautious pace? That forward guidance matters enormously. It determines how traders position in treasuries, how global capital flows adjust, and how equity valuations reset. In other words, tomorrow sets the tone not just for September, but for the entire next year. Options market signals. Looking at options pricing ahead of the Fed meeting, we see relatively modest implied volatility. The S&P 500's expected move into Friday's monthly expiration is roughly plus or minus 1.3%. For the Nasdaq 100, it's about 1.5%, with QQQ options implying a trading range centered near $591. These are not dramatic numbers. They tell us traders expect the Fed to deliver what's priced in, a 25 basis point cut and little more. But here's the catch. If the Fed surprises with a larger move, say 50 basis points, those implied ranges will be shattered. And interestingly, in the swap market, we are seeing some speculative bets on that outcome. A small but notable cohort of traders is wagering that Powell will go bigger. Right now, Fed funds futures assign only about a 10% probability of a 50 basis point cut. But the convexity of the trade is attractive. If it happens, the payoff is large. That's why some aggressive positions are building there, even if the odds are long. Fed personnel and policy context. There was also an institutional development today. Milan, recently confirmed by the Senate, will join the Federal Reserve Board as an acting governor. His voice will be part of tomorrow's dot plot, and by all indications, he leans hawkish. That could temper expectations for how fast the Fed pivots. Meanwhile, the Atlanta Fed's GDP Now model was revised higher for Q3 growth, underscoring that the U.S. economy remains resilient despite tighter credit conditions. And Washington is reportedly weighing new tariffs on imported auto parts under national security grounds. Another headline, the U.S. is preparing a $51 billion fund to promote critical minerals investment. This has implications for rare earths, oil and gas exploration, and mining infrastructure. It explains why energy producers, pipeline operators, and resource companies caught a bid today. Energy and oil outlook. Let's pause on energy. Politically, Washington has been under pressure to keep fuel costs manageable. The White House wants a weaker dollar and lower energy prices, a combination that would help exporters and consumers alike. But oil has been stubborn. For months, crude has moved sideways, not collapsing but not breaking higher either. Short-term moves have been dictated by headlines, Russia cutting output here, OPEC tweaking quotas there, rather than durable supply-demand shifts. From a macro lens, energy remains central to inflation dynamics. While core CPI excludes food and energy, households feel fuel costs daily. High energy acts as a regressive tax, squeezing consumption and confidence. That's why policymakers remain hypersensitive to gasoline prices as we head into the 2026 election cycle. Still, I don't see energy as a high-confidence long-term investment. Supply is more elastic than many think, especially with U.S. shale ready to ramp. And the political imperative is clear. Washington will lean hard on producers to prevent another 1970s-style energy shock. For me, energy equities are tactical trades, not structural allocations. Retail sales, consumer resilience. Today we also got fresh economic data. August retail sales blew past expectations, confirming once again that the American consumer is not rolling over. Headline retail sales rose 0.6% month over month, beating the 0.2% consensus. Ex-autos sales rose 0.7% versus 0.4% expected. Core retail sales, excluding both autos and gasoline, were also up 0.7%, well above the 0.3% prior. The gains were broad across non-store retailers, apparel, and restaurants, though some categories like furniture and department stores slipped. Adjusted for inflation, real retail sales were still up about 0.2%. This matters because consumption is two-thirds of U.S. GDP. As long as households keep spending, recession risk remains muted. It also complicates the Fed's job. The economy doesn't look like it urgently needs aggressive easing. Meanwhile, import prices rose 0.3%, driven by consumer goods and capital equipment, even as fuel imports fell 0.8%. The inflationary undertow hasn't disappeared. Company highlights. Microsoft made headlines today with two announcements: a 10% increase to its quarterly dividend, now 95 cents per share, a commitment to invest $31 billion in the UK over the next decade, including £15.1 billion in London-based AI labs, gaming, and cloud infrastructure. This continues a trend. US tech giants are doubling down on the UK despite Brexit, joining Nvidia, Google, and Salesforce in expanding their footprint. On the technical side, Microsoft has reclaimed $500 after several days of consolidation. That puts it back into an upward structure. The key support remains $495, with resistance in the $520 to $530 zone. Investors should remember, the final 10 trading days of September are historically the weakest stretch of the year. If funds rebalance or trim positions, Microsoft could face pressure even without fundamental deterioration. But from a long-term view, Microsoft remains one of the strongest stories in enterprise AI, cloud services, and productivity software. Its balance sheet strength and consistent capital returns give it a defensive quality, even at a premium multiple. Nvidia had a quieter day, slipping 1.6% on light volume. News surfaced that Chinese regulators may impose fines on the company for antitrust concerns, and reports indicated some Chinese tech firms are pausing orders for RTX 6000 GPUs. From a price action standpoint, Nvidia remains trapped between $168 and $183. Breakouts above that upper band could reignite momentum, while a sustained move below 168 risks forming a heavier top. Long-term, the AI demand story is intact, but valuations are stretched. Nvidia trades at over 40x forward earnings, rich even with 18% 5-year CAGR expectations. That leaves little margin for error if demand slows or export restrictions bite harder. Oracle has been one of the most aggressively bid stocks this year, but valuations look frothy. At 20 to 30x earnings, Oracle is far above its historical range, despite growth that doesn't justify a premium multiple. Yes, the company has a massive $100+ billion backlog in unfulfilled cloud and AI-related contracts, but the pace of monetization will be slow. At current prices near $292, I see more speculation than fundamentals. The risk-reward favors caution. Breakouts above $305 could carry to $325, but downside risk toward $252 remains if sentiment turns. Berkshire Hathaway. Berkshire faces a structural headwind from falling rates. With nearly $200 billion in cash, much of it parked in short-term treasuries, lower yields mean lower investment income. That's why Berkshire stock has been soft despite its fortress balance sheet. Insurance underwriting has also cooled, and the firm hasn't found major acquisition opportunities. At current levels near $451, Berkshire lacks catalysts. It still provides downside protection in crashes, but it's not a compelling growth story. Tesla is once again testing the 422 to 433 range. Options positioning suggests a pin around $420 into expiration, but if the stock can break above $433, the path to retesting $480 is clear. CEO Elon Musk's personal purchase of $11 million in stock at $390 has bolstered confidence. Technically, higher highs and higher lows confirm strength. Even pullbacks toward $400 to $390 would likely attract buyers. Tesla hasn't been a top performer this year compared to other growth stocks, but that may paradoxically help it. Funds rebalancing may trim Nvidia or Microsoft, but Tesla's lower weighting could spare it from forced selling. Broadcom, NPU segment reference. Finally, a note on Broadcom. The stock has been consolidating near 640, with technical support around 600. Analysts see fair value closer to $570 to $590, making current levels a bit stretched. For me, patience is key. I'd rather wait for a cleaner entry than chase. Macro outlook and risks. So where does this leave us? The Fed will likely cut 25 basis points tomorrow. That's already in the price. The question is whether Powell signals a faster easing cycle. If he leans dovish, equities could rally, bond yields fall, and the dollar weaken. If he sticks to a cautious path, we could see disappointment, especially in richly valued tech. Seasonality also matters. September's final weeks are statistically the toughest stretch of the calendar, with fund rebalancing, tax loss harvesting, and risk reduction ahead of Q4. Add to that geopolitical noise, tariffs, Chinese tech restrictions, energy policy, and the stage is set for volatility. Closing thoughts. To sum up, the consumer remains strong, but inflationary pressures linger. The Fed will cut rates, but the pace of cuts is uncertain. Mega-cap tech continues to dominate, but valuations demand perfection. Energy is a tactical trade, not a secular winner. Seasonality argues for caution into late September. Investors should stay nimble. Opportunities exist, but risk management is crucial. Don't chase at stretched levels and respect support and resistance zones. That's all for tonight's Stock Daily. Thanks for joining us, and as always, I appreciate your support. If you found this commentary helpful, please remember to like, comment, and share. We'll be back tomorrow evening to break down the Fed decision in real time.